It is imperative that Congress address the debt limit.
We had set a test for beginning to taper. We've all but met it on the path that we're looking at.
You have acted to make our banking system less safe, and that makes you a dangerous man to head up the Fed.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Jay Powell and Janet Yellen warn of a catastrophe in waiting. They actually tell Congress that failure to raise the debt ceiling would bring a disastrous U.S. default. A dangerous man, Democrat Senator Elizabeth Warren openly opposes Jay Powell's renomination. And TotalEnergies chief executive tells Bloomberg that energy crisis could last until winter. We'll hear from our exclusive interview throughout the program. So first thing is first, so let's quickly check on the markets. Yesterday we had quite a big sell-off in the U.S. Not so. Things are stabilizing in Europe. I don't know for how long, but the focus is definitely on Treasury yields, which are also stabilizing. Again, the concern came from stagflation. So I think there are probably two things that actually freaked out the market. First, stagflation concerns, which is when GDP doesn't really go anywhere, but inflation is rampant. And that led to a repricing in Fed expectations, led to repricing Treasuries hitting the equity market. Currently 15115, and then you can see the S&P futures also gaining a touch. I think things are looking up. Also a bit of concern on the debt ceiling, and people are saying, well, look, if you look at valuations, maybe it's time to sell some of the lofty valued stocks up, but you can still hold on to the rest. The DAX, the FTSE here in the UK and the CAC all gaining 1%, and some of the groups are actually moving the most. I think chips still under pressure, but ASML coming out with some better than expected forecast. So Jay Powell, Janet Yellen used their congressional testimonies to warn of catastrophe if the U.S. fails to raise the debt ceiling. Yellen said the Treasury will run out of cash on October 18th if Congress does not act.
It is imperative that Congress address the debt limit. If not, our current estimate is that Treasury will likely exhaust its extraordinary measures by October 18th. America would default for the first time in history. The full faith and credit of the United States would be impaired, and our country would likely face a financial crisis and economic recession as a result.
Well, the Democratic Party remains at odds also on Joe Biden's agenda, from tax and spending to Federal Reserve nominations. Progressive Senator Elizabeth Warren spoke out openly to oppose another Powell term at the Fed.
Your record gives me grave concern. Over and over, you have acted to make our banking system less safe, and that makes you a dangerous man to head up the Fed, and it's why I will oppose your renomination.
Well, joining us now is Bloomberg's D.C. morning editor, Kathleen Hunter. Kathleen, great to speak to you. How worried should markets actually be about Democrats delinking the debt ceiling from the must-pass government funding bill?
So, Francine, we're about 2 days out from the government running out of funding, and that is something that the Democrats wanted to package, is a continuation of government funding with this debt ceiling increase that the administration, Janet Yellen and others have been calling for. That was voted down in the Senate, and so now Democrats are realizing that they're not going to be able to move those things in tandem. And the problem is they don't really have a plan B yet for raising the debt ceiling. What they're looking at doing is a very cumbersome budgetary process that might take some time in the Senate. And, you know, we all know, if we look at the calendar, that we're just a little bit over 3 weeks out from October 18th. So that doesn't give Congress a lot of time to act. And so I guess this is a long-winded way of me saying that markets should be getting a little bit more concerned. You know, Congress does tend to work in a last-minute basis where they tend to pass things, you know, at the 11th hour and come together and do things. The fact that Republicans have been staunchly against raising the debt ceiling as part of a spending bill, and it's unlikely that they're going to support any kind of debt limit increase at this stage, means that Democrats are likely going to have to do it with Democratic votes alone, and that could be a time-consuming process, and it's unclear how they're going to get there in the time that they have.
So, Kathleen, what are the political implications of Democrats raising the debt ceiling without any Republican vote?
Well, so Mitch McConnell, the Republican leader in the Senate, has been very adamant that Republicans won't vote in favor of a debt limit increase as long as Democrats are simultaneously pushing forward with their plans to pass Biden's economic agenda, his Build Back Better and Family Jobs plan. That's obviously something that Democrats are pursuing, and so Democrats are likely going to have to do this on their own. Now, there's a lot of history of bipartisan debt limit increases, even the most controversial one that sparked the only downgrade in U.S. credit in history in 2011, a decade ago. Even that eventually was passed on a bipartisan basis. So McConnell's a little bit out of form here in terms of what's typical, but it looks like he's sticking to his guns. And so what we could end up with is what we're likely to end up with is a Democrat-only passed debt limit increase. And if that does happen, what we're likely to see is Republicans attacking Democrats in the run-up to next November's midterms, the November 2022 midterms, in which both the House and the Senate could be up for grabs. The Republicans are looking to take control of the House, perhaps even win the Senate as well. And I think that part of McConnell's play here is that he's trying to tag the debt limit increase along with the potential spending increase along with as part of Joe Biden's economic agenda. He's trying to tag that as something that Democrats themselves are going to have to own, and that's going to play into Republican messaging heading into the midterms.
Kathleen, thanks so much. That was Bloomberg's D.C. morning editor, Kathleen Hunter. Now we're joined by Rebecca Chesworth, senior equity strategist at State Street. Rebecca, when you look at some of the repricing that we saw in equities, how much does it have to do about political concerns in the U.S. or even, the second term for Jay Powell, and how much is it just like a healthy correction because of inflation expectations?
Well, good morning, Francine, and a great question to start on. I mean, it's certainly very powerful, those video clips that you just shown, and we realise that there's a lot going on to digest. It's very political, this whole debt process, the whole infrastructure bill, and indeed everything that's happening at the central bank in the US, very political process behind that. But actually, I think the driver that we saw yesterday, as you mentioned earlier, was largely inflation-driven, largely debt markets, what's happening to bond yields. But also, if you think back to last week, then we were talking about Evergrande and the Chinese slowdown. That's having an impact. And indeed, the whole tapering process is having its own impact as well. So several things are coming together. But as we see today, with the green on the screen in Europe, a lot of that is now being put into context.
Yeah, but do worries come back, Rebecca? So it's unclear why, these flare-ups happen. Is Europe somehow delinked because of some of the valuations, or could it actually make the brunt if we have a bigger and deeper correction?
Yeah, good question, actually, because there's been all year, investors have been ready to move from the US to Europe. So US was the first to come out of recession, the COVID-inspired recession. It was reopening quicker. But investors knew that at some point they'd have to jump to Europe as the baton got handed over for growth. So Europe is cheaper. It's got a smaller technology sector, a smaller impact of FANG stocks, these big growth stocks, which are going to be impacted more as interest rates rise. So that's another reason. And also, as you say, there is a delinking because it's not quite so political, and many of these concerns causing the volatility are US-based at the moment. But largely, the markets will work in tandem, and a lot of what we're seeing behind the scenes, so eventually we're moving on to a tightening policy agenda that will affect all markets in time.
Rebecca, what do you make of the energy crisis, and how much second and third term effects could we see from that? I know we'll focus on it a little bit differently, but is it changing your view on the industries? Well, I think so. So I think what we've seen from everything we've seen, from sitting in the UK and the natural gas crisis and the petrol station crisis, etc. I think this has taught us that you ignore energy at your peril. And I think what we'd seen over the last couple of years was a lack of investment, lack of returns, and a lot of this is bundled up in the way investors look at the market now. Importantly, ESG and climate change have come to the fore, so they have moved people's minds away from energy and energy supply. But we see that whenever there are constraints that come into place, and you get constrictions like Hurricane Ida, and you get stockpiles being brought down, so what happens is, as you see that supply reduce, you've not seen any new supply really come on, and then you're seeing the demand rising, importantly, as you reopen, as airlines start to get busy again, then that all comes together, pushes up the oil price. Now, that could be
good for one part of the stock market. Clearly, we saw one sector and one sector only rise yesterday, and that was energy. But there are then knock-on effects for other industries that have to cope with those price rises.
Rebecca, thanks so much. Rebecca Chesworth there from State Street stays with us, and we'll talk a lot more about the energy sector. Now, smart conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we'll also speak exclusively to the Central Bank of Ireland governor and ECB Governing Council member. He's Gabriel Makhlouf. So you can send us your questions on IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, as the energy crunch goes global, the chief executive of the French major Total Energy says the surge in gas prices could last through the entire winter, although he doesn't fear shortages in Europe. Patrick Pouyanné also spoke to Bloomberg about the transition to renewable energy.
I think it will go through winter because honestly, it's the first time that we see such high prices in summertime. It's very unusual. It did not start from Europe. It started from China. Very huge Chinese demand during the first half, an increase of 35% of LNG demand in China compared to 2019. So all the LNG from the US went to Asia because of better price. So it's, of course, it lifts the prices in Europe. Inventories are low, so entering into wintertime with low inventories obviously is not a good idea. So it all depends about the meteor. I don't know. So it's why answering to your first question of the future hike, we don't know. It's either we have a mild winter or not, but it's clear that we are facing such an unusual situation, which means, by the way, that it's also the proof that natural gas has a role to play in the energy transition, and this is why Chinese demand is so high.
So this will last until when? March 2022?
It's difficult to know. I mean, I'm not, but winter, it's March, April, but again, we don't see what really could be the alternative to that. So it will depend again on the temperatures during winter time. So I'm not Mrs. Meteo. I don't expect some shortage of gas. I think the question, of course, will be if it's going too high, then you could see some strange move. The UK thinking to restart some coal-fired power plants. Even some countries are speaking about fuel fired power plants, which would be not good at all for climate change.
What do you think OPEC Plus can do in order to limit this increase in prices for the rest of the year?
What they could do, of course, is produce more. The other source of higher production, by the way, will be the U.S. shale oil, because obviously you have players which have been also very prudent. It has been a surprise. I think that at $80 per barrel, maybe some of them with less cautious will restart some wells, and then you could see again. But all that is a little delay. So we have entered into, I would say, a cycle of high prices, lower investments. Generally, in the oil business, when prices are so high, people begin to invest more, and then you create the new cycle. So
you think the cycle will go through the winter as well, or will go longer?
Yeah, it might. It's possible. Honestly, I will tell you. Honestly, I would in February, this interview last February, I would have never bet that we would be at such high prices. So I mean, what is true on oil is that you have a global dynamic which is not in favor of investment. Climate change, in particular in Western companies. We are investing less in oil and we are putting more money in renewables as Total Energies. So you have this trend does not incentivize people to rush. I think in the shale oil in the US also you have some consolidation, many players buying others. So less players, so probably less investments, more discipline, I would say, in the oil market. The question again will be how long will it take for people to forget?
That was Patrick Pouyanné, Total Energy Chief Executive, speaking to our Caroline Conan in Paris following the company's Investor Day. Now, the energy crisis in Europe, now rearing its head in China, sits at the crossroads of a vast global energy transition. Here are what some of the energy chief executives on Bloomberg TV had to say this week.
This is just the first inning of a multi-year, potentially decade-long commodity supercycle. It's driven by, we have the war on climate change.
This should be a wake-up call to really speed up the transition towards a fully sustainable economy.
What we need to do is invest more in renewables.
We'd love more batteries to be stored in the UK.
If electricity prices drop, you simply produce more and store it. If electricity prices rise, you simply take it out of storage. So that's really what we're missing right now.
Let's get back to Rebecca Chesworth from State Street. Rebecca, we talked a little bit about the energy crunch and actually what it meant for equities in general. Can you take advantage of the renewable boom? And if yes, how?
Well, I think everything we've heard was spot on. You need that renewables, but it's not coming quite fast enough. And we've definitely seen over the last couple of years large premiums attached to companies that are building that renewable energy supply. But in the meantime, you still need the, let's call it the old school, the old economy, oil and gas, which we've heard from one of your presenters earlier. And that's still something that can be benefited from. It doesn't fit all portfolios. It's not going to work for people who are looking for the climate change, but there is that need to carry on with production of some of the fossil fuels until we get to that new economy and the renewable energy.
Rebecca, is there anything right now that actually you would be particularly buying into? I don't know if there are commodities that we need to use or, old fossil fuel that we need to use, for example, when turbines don't work like they should. So for some of these intermittent power shortages, or whether maybe some of the rare earths.
Well, I mean, so there's two sectors that really play into that. The one area that's seeing a lot of excitement and has done all year is the materials area. So that's the miners. They've benefited from this commodity super cycle and a lot of the metals and the minerals going up there. But you do have some cost pressures in other parts of that sector. So really where investors are looking at now is at energy. The energy sector has a high correlation with oil prices. Oil prices are clearly a key determinant of inflation. So investors have been buying energy as a hedge against inflation. They've been buying energy because it's cheap and there's been that move back to value. And they've been buying energy because it plays into the recovery as we continue to reopen operations post-COVID.
Thank you so much, Rebecca Chesworth, there, Senior Equity Strategist at State Street, joining us this morning. Now, Smart Conversations continue right here on Bloomberg Surveillance Early Edition. Later this hour, we'll be speaking exclusively to the Central Bank of Ireland Governor and ECB Governing Council member, Gabriel Makhlouf. You can send us your questions on IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. Fumio Kishida is set to become Japan's prime minister after the ex-foreign minister overcame popular reformer Taro Kono to win leadership of the country's ruling party. Kishida will likely be appointed on Monday to succeed outgoing Prime Minister Yoshihide Suga, putting him in charge of the world's third largest economy. The self-effacing former banker has promised tens of trillions of yen in extra government spending. China has stepped in to buy a stake in a struggling regional bank from Evergrande as it seeks to limit contagion from the embattled property developer. Evergrande is offloading a 20% stake in Shenzhen Bank to the local Shenyang government for just over $1.5 billion. According to a Hong Kong Stock Exchange statement, all proceeds will go to settle debts with the lender, leaving nothing more for bondholders. New data on the gender pay gap in UK investment banking is due next week, and so far the numbers aren't showing any improvement. A sample of 10 large banks that have already reported showing an average 44.5% difference between male and female hourly wages as of April 2020. That compares with 45% reported the previous year. The figures don't measure pay for doing the same work, but the data show men hold most of the highest paying jobs in the industry. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Thank you so much, Laura, right there. Now, this is what the markets are saying. One of the big questions as we went into the market open here in Europe is whether the sell-off that we saw in the U.S. would then translate into Europe. For the moment, we're actually seeing the Stoxx Europe 600 holding on to gains. U.S. futures also rebounding. Now, the figure is this. The moves in the 10-year Treasury yield really signaled a turnaround when equities extended losses amid concerns over stagflation, also concern about Evergrande's debt crisis. It seems that the moderation in yields now are providing a breather to investors that have been concerned about some of those moves, some of those valuations. And of course, what they're really worried about is that higher rates may induce the present value of equity cash flows because some of them are lofty. So we're seeing a bit of stabilization. I don't know how long it lasts, but certainly something that we need to keep an eye on. Smart Conversations continue on Bloomberg Surveillance Early Edition. Up next, we speak exclusively to the Central Bank Governor of Ireland and ECB Governing Council member Gabriel Makhlouf. You can send us your questions on IB plus TV Go. We'll be talking inflation. We'll, of course, be talking energy. This is Bloomberg. Jay Powell and Janet Yellen warn of a catastrophe in waiting. They tell Congress that failure to raise the debt ceiling would bring a disastrous U.S. default. A dangerous man, Democrat Senator Elizabeth Warren openly opposes Jay Powell's renomination. And TotalEnergies chief executive tells Bloomberg that the energy crisis could last until winter. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 29th of September. Let's get straight to our top story, market story with our Danny Berger. Of course, the focus is very much on equities after we saw the sell-off in the U.S. Today, though, European markets kind of taking it in their stride, actually pushing higher, Danny.
Yeah, they are. Look, we were higher before. We were higher by as much as 1% about an hour or so ago when the markets opened. So at an 0.8% gain, this certainly isn't enough to undo the more than 2% sell-off we saw yesterday in European equities, the worst sell-off in 2 days. But still, it's a little bit of a reprieve. Same goes for U.S. futures, up 0.6%. So we're taking a pause. It's dip buying across the board, whether you're looking at equities or bonds. I do want to say pay attention to what's happening in the gilt market. We're currently basically unchanged. We did move above 1% for the first time since March 2020 in the 10-year, but this really filtering through to what we're seeing in the U.S. But really, the phrase of the day comes from Bank of America, and that's a Pavlovian buy the dip response. That's how they characterize what's been happening in markets. And they say that this shows that we're more fragile. It perhaps could be what's happening today, that we're getting that Pavlovian response that every time we sell off, we go in and we buy the dip. So they say that this only raises the risk of larger fragility shock before the year ends. So this is a warning that they are flagging. And of course, higher yields still a concern, Francine. I also want to point out the term premium, because even though we are having people jumping back in and buying debt today, we have seen the term premium, or the compensation that investors are demanding to hold 10-year paper, creep back above zero for the first time in quite a few months. Again, this just really tells us that investors are concerned. They see risks out there, be it inflation, be the debt ceiling, and they are demanding more money to hold 10-year paper versus short-term paper that they just roll over. So again, Francine, this is somewhat behind that yield rise as well.
Danny, thanks so much. Danny Berger there with the very latest on market moves, especially yields. So while Europe is enduring the fastest price increases in a decade with a rate of 3%, ECB President Christine Lagarde said the spike is largely transitory. Now, she points out that forecasts show inflation could be as little as 1.5% by 2023. The Irish Central Bank Governor, Gabriel Makhlouf, however, believes this forecast is too pessimistic, that 1.5% by 2023 is too low. We are delighted to be joined right now by the Central Bank of Ireland Governor. He's Gabriel Makhlouf, joining us for an exclusive conversation, currently participating in OMFIF's Sustainability Policy Institute Symposium. So, Governor, thank you, as always, for giving Bloomberg a little bit of your time. Let's start by talking about yields. If you look at bond yields, they've risen pretty sharply since the ECB meeting this month. How much of a problem is this for the euro area?
Well, good morning. It's good to join you again. I mean, I think the vaccination program has worked and economies are recovering. And that's very good news, and we should recognize that. What we're seeing out there is a bit of a conundrum, because we're seeing labor markets slack, but we're also seeing supply blockages, perhaps not unexpected in view of the pent-up demand, certainly in services. So I think we need to see this play out. And I heard what you said just a few seconds ago about inflation. I mean, I completely agree that what we're seeing today is transitory. It's driven by transitory factors. But we do need to do two things. One, we absolutely need to be conscious of the significant shock that we've just experienced and that we're now coming out of. And we need to be aware of the risks that some of these supply shortages and blockages actually persist, and they may turn out to feature in inflation down the road. So we need to be humble that our models are not necessarily used to operating with the sort of pandemic that we've just been through.
So, Governor, are you saying that actually some of these supply chain issues, some of these higher prices will have an impact on inflation, or could they even have an impact on the economic outlook for the euro area?
No, I mean, I think I didn't say will, I said they could, and we need to be extremely vigilant and observe the data and what's happening. But we know, for example, just to pick one example, that the semiconductor issue, which is a blockage, a supply issue right now, especially for the car industry. Some indications that I have read talk about some manufacturers taking till the end of next year to come out of that. So that for me is a sort of signal that we need to be cautious about exactly what's happening and what may influence price pressures down the road. I'm not saying will, I'm saying could. But I think the economic outlook overall actually is positive. I think we have to recognize, as I said at the very start, the restrictions are being lifted and we're seeing economies recover. There are absolutely risks out there, and there's a degree of uncertainty we should all be aware of.
If supply shortages actually last longer, are they more likely to entrench faster inflation because of wage growth?
Potentially. I mean, that's the risk that we at the ECB need to be very conscious of and very aware of and ready to respond to if it happens. Of course, the pandemic could have also resulted in structural change that pushes in the opposite direction. So right now, I think it's the key word, I think, is vigilance that we need to maintain. And certainly that's what I'm doing.
Do you think, bond yields having risen will actually prompt the ECB to do something? So either leaning in with higher pandemic purchases or actually, looking at changing something at the margin?
Now, the ECB is absolutely committed to its price stability mandate. We completed our strategy review back in July. We set out very clearly what our plans are. Our main focus right now is to ensure that we understand what's happening to economies and to the euro area economy as it emerges from the pandemic, and that we're ready to respond as necessary. I mean, right now, as I said only recently in a speech, I don't think we should be looking to raise rates or respond to transitory inflation. I mean, I think that would be a mistake. On the other hand, we just need to be very conscious that there is a lot of uncertainty out there, and we need to be ready to respond to it.
We saw a more hawkish turn from the Bank of England and from the Fed. What does that mean for the ECB?
Well, it means that we are seeing economies opening up around the world. And I think, this is good news, right? I think this is good news, and we have to keep remembering that this is good news. And certainly when we talk about inflation, Bear in mind that in the euro area, we are looking to push up inflation to our aim of 2% over the medium term. So the messages from the Fed, the messages from the Bank of England, the messages from around the world is recovery is coming. And for us at the ECB, we just need to make sure that recovery comes in a way that achieves price stability.
Governor, if we see entrenched inflation, when would you actually see that?
Well, we're not seeing it right now. That's absolutely the case. I mean, as I said, we are right now, what we're seeing is transitory effects. We'll see that in due course if the data shows it to us. I mean, we'll need to see that, see what happens to wages, see what the response is by industries and sectors. So right now, I don't believe there is a risk of excessive inflation of the sort that I read about in the newspapers, partly because the ECB is absolutely committed to delivering on its mandate. And also, as I said, I think what we're currently seeing are these transitory pressures, but we just need to be very vigilant of the risks out there.
Given what you've just laid out, will PEP actually end on time at the end of March?
We're going to be, well, we're going to spend our December meeting coming to a view on that. I mean, at the moment, my own view is a program that was set up for an emergency at the start of the pandemic. As we see the emergency disappear, there are logical consequences to that particular program. On the other hand, there's a long discussion to be had at the ECB. There's a lot of uncertainty around with what's happening, as I said, in economies. And we're going to take all of these factors into account to ensure that ultimately favorable financing conditions continue. Right now, we've got them, but that's a judgment we're going to be making in December.
So a lot of economists, Governor, are expecting, the asset purchase program to be increased as PEP actually gets wound down. Would that be the right way of looking at things?
I think the right way of looking at things would be to wait till we make our judgment in December.
Fair. When you look at some of the longer-term impact of, climate change and some of the policies related to that, is that inflationary in the long term?
It could be. It could be. It depends ultimately, of course, on what the policies designed to achieve the transition to net zero, what they are, and how industry responds to them. But on the face of it, there will be, in my view, an inflationary impact of the transition. But the extent of it is something that's very uncertain, certainly to my eyes, right now.
And this, Governor, why? Because it's new technology that is more expensive, or simply, because it's difficult to transition?
No, I think it's a combination of things. I think the scale of the transition that's needed in the economies to achieve net zero is very, very significant. And I think probably more significant than many people realize. And right now, there's a lot of talk about what needs to happen. There are some ideas about what needs to happen, but actually we're not seeing a lot of that settle into a state where we can be more definitive about its impact on price pressures and how economies and industries will actually respond to it. I mean, I think we're at an early stage of it.
Governor, thank you so much. Always a pleasure to speak to you. Gabriel Makhlouf there, the Governor of the Central Bank of Ireland, joining us this morning for an exclusive conversation. Coming up, a dangerous man. Senator Elizabeth Warren hits out at Fed Chair Jay Powell and says she'll oppose his renomination. More on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, sticking with energy, the WTO says the energy crunch in the UK and China have different causes. The Director General Ngozi Okonjo-Iweala spoke exclusively with Bloomberg's Haslin Diamond.
The energy crunch in the UK and China may be slightly different origin. I think the UK is more of a labor problem, not the supply of oil, but getting it to where it's needed. I think, with respect to the recent situation in China, where factories have been asked to cut down on their energy use, that will definitely impact trade. We are at a period when there is a demand, pent-up demand, due to the fiscal stimulus that was given very appropriately by many countries to households and businesses. There's a lot of demand on the side of households, but there's also a lot of demand on the side of businesses who are some of them are stocking up for inventory purposes. This is another way they manage risks. So if you put the business demand together with households and you mix that with a cut in supply coming from China, yes, definitely, I think this trade will be impacted. I hope not for long. I hope it's temporary.
Might it impact China's growth because it is already slowing? Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, port delays, chip shortages, settled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery. So that's why I say, I hope it's not for long, because that will have a feedback loop into the rest of the global economy.
Well, that was the WTO Director General Ngozi Okonjo-Iweala speaking to us exclusively. Now, few positions in the world have more sway over the movement of markets than a seat at the Fed. It's where American monetary policy is set, from which virtually every asset class takes its cue. 2 Fed presidents resigned this week after disclosing trading activity conducted last year. While no rules were broken, it's drawn intense criticism and raised ethical questions. And at a congressional hearing yesterday, Senator Elizabeth Warren criticized the Fed chair to his face, calling him a dangerous man who has made the banking system less safe. Now, she also opposed his re-nomination. For more on all of this, we're joined by Simon Kennedy, Bloomberg's executive editor for economics. Simon, great to speak to you. So first of all, Elizabeth Warren was pretty punchy. What are the accusations that she's leveling at Jay Powell?
So her main case is that as kind of the head regulator, Jay Powell has loosened regulations on Wall Street and banks, and obviously she has fears of the 2008 financial crisis, a period that led to her being elected to the Senate because she was so outspoken about how Wall Street had behaved in those circumstances. Powell pushing back, saying that banks are better capitalized now, but certainly for Elizabeth Warren and some on the progressive side of the Democratic Party, the argument is that he's been a bit more light touch on regulation than they would have liked.
So, Simon, give us a sense of, first of all, whether that actually impedes his renomination. What's the thinking of that? How does Joe Biden, need to keep the progressives on side?
So the thing to remember here is that Jerome Powell is a Republican. He was nominated by Donald Trump, and so there are some on the Democratic side who will argue that that Joe Biden should do what Trump did, which is put one of their own in the Fed. Typically, the Fed has been a non-political. People of different political persuasions in the White House have elected chair people from the other party. And some on the left, including obviously Elizabeth Warren, feel that you need to put someone in there who's tougher on regulation. The candidate out there that would fit those descriptions is Lael Brainard, who's currently on the Fed. But that would probably be a harder confirmation battle for the president. Jerome Powell has a significant bipartisan support. He would obviously attract the votes of many Republicans, some Democrats, and that would probably give him quite an easy confirmation path to a second term. At the same time, the progressive part of that Democratic Party, extremely vocal. Elizabeth Warren is a spokesperson for that group. We await to see what other members of that caucus say, but it slightly clouds the focus for President Biden.
Thank you so much, Sammy Kennedy there, our executive editor for economics, joining us on, of course, this very important development. Now, coming up, Peloton extends declines following news that Amazon is launching a rival service called Halo Fitness. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So Amazon is launching a service called Halo Fitness, which will include video workouts from top trainers and personalized nutrition tools. The service will actually rival offerings from Peloton and Apple. Now, for more on all of this, we're joined by Bloomberg's Laura Wright. So, Laura, good morning. How, first of all, is Amazon entering the fitness space?
That's right, Francine. Well, we heard yesterday that Amazon is entering that interactive fitness space with Halo Fitness. Now, it's an application. You download it on your mobile phone or any other tablet. It includes over 100 workouts. Now, how to get your hands on this? After a 6-month trial, you can access it for $3.99 a month. It can also be paired with the Halo Band, a wrist-worn device which can monitor heart rate during workouts. And this really filters into Amazon broadening its subscription service offering. Now, off the back of the news, we saw that Peloton shares declined. They sold off sharply yesterday. The stock trading at the end of the session down around over 4%. So Peloton, they've got some competition. Peloton was actually one of the big pandemic winners, but they've struggled year to date as economies reopen and consumers are no longer stuck at home.
So what other products, Laura, did Amazon actually announce yesterday?
We heard about the launch of Astro. It's a home robot, very small. It can move 1 meter a second. It has a screen, even cup holders on the back, Francine, if you're feeling lazy and would like your coffee delivered to you. But again, the wider theme here is about this diversification into electronic products. We have the Alexa, there's the Amazon Fire TV, now the Astro robot. So year to date, if we flip up the screen, Amazon has actually underperformed other FANG stocks. It's moved sideways. So really this broader diversification into electronic products is part of Amazon's strategy to gain more market share and maintain its valuation. But one investor seemed pretty unconvinced, Richard Windsor from Radio Free Mobile. He struggled to see the relevance of this product, stating no one is really sure what this device is for other than having a dog that doesn't need to be house trained, which is why it's going out as an invitation-only product at launch. Francine, do you fancy one?
I mean, maybe. I don't know. Does it cook? Does it exercise for me, Laura? I'm going to look into it, but definitely I need a little bit of help. We all do. Laura right there with the very latest on some of these cool Amazon products. Now, Bloomberg Surveillance Early Edition continues in the next hour. Danny Berger and Kailey Leinz join me. We'll get markets. We talk energy. This is Bloomberg.
The key challenge is to ensure that we do not overreact to transitory supply shocks that have no bearing on the medium term.
Clearly, inflation this year is going to be above 2%. Just the experience so far this year makes that clearly true.
As the economy continues to reopen, we are seeing upward pressure on prices, particularly due to supply bottlenecks in some sectors.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, September 29th. Our top stories today. Rebound. U.S. futures, indice futures, and Europeans show signs of recovery a day after that massive sell-off. Doom and gloom for the Democrats. Progressives and moderates battle over President Biden's economic agenda, while the government is at risk of defaulting on its debt. And China to the rescue. Authorities take a stake in a struggling regional bank owned by Evergrande. It's an attempt to limit contagion from the embattled property developer. Well, good morning, everyone. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. Matt Miller is off this week to get hitched. Kailey, the markets, actually, we were expecting some kind of fallout, given what we saw in treasuries and given what we saw in U.S. markets yesterday. But actually, Europe stabilizing, bond yields stabilizing.
Yeah, buy the dip seems to be the theme in Europe and the U.S. this morning, Francine. That wasn't necessarily, though, the case in Asia. Actually, stocks overnight were broadly lower. The MSCI Asia Pacific Index had its worst day in about 6 weeks. Even Japan was a big underperformer, the Nikkei falling about 2%. Of course, Japanese markets closed just before the results of the vote for the next leader of the ruling party were announced. Fumio Kishida will be, it looks like, Japan's next prime minister. Stocks were also down in South Korea, in Taiwan, in China, though a little bit about performance from Hong Kong. The Hang Seng up about 0.7%. Of course, the story the market is still paying attention to is what's going on with China Evergrande. They have another dollar bond payment due today after there is no indication that they paid the one due last Thursday, getting another downgrade from Fitch because of that. But China also stepping in a particular way, buying a stake from a struggling regional bank, a 20% stake from Evergrande, but the Evergrande has to prioritize paying off debt for that bank. So that is a saga we continue to watch. Something else we're watching in China is the possibility of them raising power prices due to the energy crunch. And that actually gave a small lift to some energy producers in China, one of them being Huadong Power. It was up 1.7% in the overnight session. Finally, I would just point in FX to the South Korean won, rebounding off of its weakest level in a year against the dollar, up about 0.2%. Now here in the U.S., as I said, buy the dip seems to be the name of the game today. We saw steep declines for equities, the worst day for the S&P 500 since May, the worst day for the NASDAQ 100 since March, as we saw yields spiking higher. But those moves are reversing today. We have S&P futures up 0.7%, and we are seeing the VIX come down after spiking to around a 25 handle yesterday. Right now, we're at 21.88. Of course, these moves in the equity market come as the bond market also gets a bid. The 10-year yield moving lower by about 3 basis points. We're back down to 150. And then pointing to crude as well, Danny, also retreating today after giving up gains yesterday. WTI down about 0.8%. Right now, we're trading around $74.65 a barrel.
Very similar dynamics happening here in Europe, Kailey. And one thing just adding fuel to this very positive day is some breaking lines about Euro area September economic confidence. It not only has it risen, it has beaten estimates. It came in at 117.8. The estimate was 117. So that's some more data to say, okay, things are getting better. People are more optimistic. But to be clear, we were already gaining here. And it is really just a reversal from yesterday. You have some of these regional benchmarks moving higher by more than 1%. You have Germany, you have France, both of them higher by more than 1%. Spain just shy of that whole round number. But to be clear, this doesn't undo the damage we saw yesterday. It was a more than 2% drop for these European indices. So this less than 1% drop, it's not going to cut it, but it is dip buying, as you said, Kailey. I think the phrase of the day comes from Benjamin Bowler over at Bank of America, a Pavlovian buy the dip response. That's certainly what we're seeing today. But we are seeing, I think, interestingly, a weaker euro and a weaker pound. Sterling right now hovering around its lowest level since January. These really are these fears of stagflation creeping into the market, of what the central bank can even do if we have this energy crisis continue to weigh. So your cable rate at 135.07, euro dollar at 116.66. Some dip buying happening in yields too. Your 10-year yield still below 1% after hitting that mark yesterday, Francine, for the first time since March.
Yeah, a big interview also we had with the Irish Central Bank governor, part of the ECB board, and he was saying, look, we have to watch energy prices. We have to see whether it translates into something more substantial in terms of inflation. He doesn't see at the moment, but he reminded everyone that the ECB needs to be ready to act. Now, look at what else is ahead today in the U.S. Senate Democrats are seeking a vote on a stopgap funding bill to avert a government shutdown. The inaugural meeting of the Trade and Technology Council is also set to kick off in Pittsburgh, where officials from the U.S. and the EU are actually set to meet. Now, U.S. Defense Secretary Lloyd Austin and Joint Chiefs Chairman Mark Milley face a second day of questions over Afghan military's failure and the withdrawal from Kabul. This time before the House Armed Services Committee. Then, 11:45 a.m. New York time, central bank chiefs Jay Powell, Christine Lagarde, Andrew Bailey, and Haruhiko Kuroda participate in the ECB Forum panel. They're likely to face tough questions over tapering, inflation, and global risks. We begin in Washington, though, and Treasury Secretary Janet Yellen, Fed Chair Jay Powell appeared before the Senate Banking Committee yesterday, and here's what they had to say about raising the debt ceiling.
It is imperative that Congress address the debt limit.
I think it's essential to raise the debt ceiling in time to avoid payment defaults of any kind.
If not, our current estimate is that Treasury will likely exhaust its extraordinary measures by October 18th.
Potential effects could be severe.
America would default for the first time in history. The full faith and credit of the United States would be impaired, and our country would likely face a financial crisis and economic recession as a result.
Let's get straight to Anne-Marie Hordern, our Bloomberg Washington correspondent, joining us from our D.C. bureau. Anne-Marie, how much should markets worry about the fact that Democrats want to delink the debt ceiling from this must-pass government funding bill?
I think the markets are paying a lot more attention now because we, of course, are coming up to the deadlines. And as journalists, we all love deadlines. So let's start with avoiding a government shutdown first, Francine. There is going to be a bill introduced in the Senate, potentially for a vote as early as today. And it's, quote unquote, a clean bill. So it doesn't have the debt ceiling in it, but likely it would have bipartisan support, at least to keep the government operating past Thursday. So come 12:01 Friday, the government can continue paying those Social Security checks, troops, et cetera. That's what we mean when we talk about a government shutdown. Then they have the looming crisis of the debt ceiling, which we just heard from Secretary Yellen yesterday. She also wrote a letter to congressional leadership saying that that X date is close to or on October 18th. So that's really what we're working towards. The problem is the Republicans will not sign up for that. So the Democrats at some point potentially will have to go it alone. They're still working out how they want to go about this. There was a lot of debate yesterday on different avenues potentially to take. But if the Democrats were to do it alone, it's about a 2-week process. They have to go through that same reconciliation budget framework process to avoid a filibuster in the Senate. And that brings us just a few days close to the October 18th deadline. So you'll see markets really start to pay a lot more attention as we go through the weeks.
Yeah, and time is short. But the real fireworks in yesterday's hearing, Anne-Marie, came from Senator Elizabeth Warren when she pressed the Fed Chairman Jerome Powell to his face on his record on financial regulation and said she wouldn't support him for a second term. Take a listen.
Your record gives me grave concern. Over and over, you have acted to make our banking system less safe, and that makes you a dangerous man to head up the Fed, and it's why I will oppose your renomination.
So, Anne-Marie, for President Biden, how does he balance progressives like Elizabeth Warren who don't want to see Powell reappointed versus his own Treasury Secretary Janet Yellen and moderates who have expressed support for him?
This is just yet another inconvenience, really, for the Biden administration. And talk about awkward. Treasury Secretary Yellen was sitting right there next to Fed Chair Jay Powell. This is going to be a moment where the Biden administration has to decide really which way they want to go. It's likely that Treasury Secretary Yellen carries a lot more weight in the sense that this is part of his cabinet. He trusts her judgment. But he's going to have to, at some point, potentially try to pacify the progressives, which they're also trying to get on board, of course, for Thursday's hard infrastructure vote. So this just shows another divide within the party. Potentially one way the White House could go about this is to appoint Governor Brainard to a higher, potentially vice chair of regulation. That's potentially one way they could try to check both boxes for this. But it's just an inconvenience, really, for the administration that you have really two dueling ideas within their own party.
All right, our Anne-Marie Hordern in Washington on Deadline Watch. Thanks so much. Now, from D.C. politics to politics in Japan, where Fumio Kishida is set to become the next prime minister. The former foreign minister won the leadership of the country's ruling party and is expected to be named to succeed outgoing prime minister Yoshihide Suga. Fumio Kishida holding a briefing now in Tokyo. You're looking at those live pictures. Let's get more from Sophie Jackman, our Bloomberg Tokyo deputy bureau chief. So we have all but certain a Kishida incoming government. What exactly does that look like, Sophie?
Indeed, Fumio Kishida winning that contest today. He's not the most popular of the candidates among the rank-and-file party members, or indeed among the public. They were big fans of reformer and the current vaccine minister, Taro Kono. But among the senior party leadership and the various factions that make up this party, Kishida was the winner on the day. He has to appoint senior leadership positions within the party, and then he also has to set up a cabinet ahead of a general election. He will probably set up that cabinet just in the next coming days, and then the election must be held by the end of November. What are we looking at with Kishida? He says he is in favor of new capitalism. What does that mean? He's pushing for a stimulus bill of trillions of yen by the end of the year to try to pull Japan out of this coronavirus pandemic, stimulate the economy. When it comes to foreign policy, he was previously seen as a dove, foreign minister for a long time there in the administration of Shinzo Abe. But while campaigning for this position, he took a bit more of a hawkish stance, saying that the Taiwan Strait issue needs to be taken extremely seriously.
Yeah.
So we'll see what kind of Kishida we get in the coming days.
Sophie, thanks so much. Sophie Jackman there. And you can, of course, continue to follow our coverage of Japan's vote at TLIV Go on your Bloomberg terminal. Now on to China, and it's stepped in to buy a stake in a struggling regional bank from Evergrande. That's as it seeks to limit the contagion to the financial sector. Well, let's get more on this with Bloomberg's Tom McKenzie. Tom, so how significant is this actual deal, or how significant is it in the thinking of China trying to limit the fallout?
Oh, it's more about that. It's more about the fact that you do have now state intervention. It confirms that. The price, the dollar number is, look, 1.5 billion US dollars in terms of the stake that they've sold down in this regional bank. But the fact that the regional government came in and bought this part of the stake, of course, puts another piece in the puzzle, because the Evergrande story is like a 5,000-piece puzzle that needs to be put together, and we're slowly getting a number of those pieces lining up. There's a lot more that remains on the table, of course. What this does is confirm the reporting that we had last week, that the government has told local governments and state-owned enterprises to be ready to step in to try and shore up the system without going as far as a bailout, but to be doing exactly what they've just done in the last 24 hours, which is buying a stake.
Right, and shore up the system being the banking system. So if I'm a bondholder, should I be worried then?
Well, this underscores the fact that the priority will be ensuring the stability of the banking sector, and we also know, of course, is ensuring that householders and those people who've put deposits down, about 1.6 million people on these units that have yet to be built by Evergrande, they will get priority as well. Nothing has changed the fact that in terms of the hierarchy, foreign bondholders, those bondholders and those owners of US dollar bonds are likely going to be close to the bottom of the list. We haven't seen anything that changes that dynamic in the last 24 hours or so.
Yeah, and of course, another dollar bond payment, $45.2 million is due today. We will see if that coupon is indeed paid. Thank you so much to Bloomberg's Tom McKenzie. Now let's take a look at some stocks moving in pre-market trading here in the U.S. And I have to begin with Micron. Of course, the chip company reported after the bell yesterday, gave a pretty disappointing outlook because it sees supply or demand for its chips from PC makers waning. That stock is down about 3.25%. But another stock in the chip space, AMSL, which of course makes the equipment that makes semiconductors, gave a more upbeat forecast all the way out to 2025, saying it expects as much as $35 billion because of the supply crunch and chip makers needing to ramp up their production. That stock is up about 1.2%. And an even bigger to the upside is Lucid Motors. Its debut electric vehicle sedan is in production. It's a $169,000 car, can go 520 miles on a single charge, and they expect deliveries to start at the end of next month. So that stock is up 9.4% before the bell, Francine.
Yeah, called the Air Dream Edition. I can't wait until Matt Miller is back so he can tell us if it looks good enough for him or not. So, Kailey, coming up, Ed Clissold, Ned Davies Research Chief U.S. Strategist, will talk about Treasury repricing. We'll talk about inflation expectations and equities. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua in London alongside Kailey Leinz in New York. This morning, I want to talk about the perennial underdog of this market, and that is, of course, the value traders. And I have a chart up here. I want to welcome our radio listeners as well. I'll explain the chart to you. Essentially, I have two lines up here. One is a market-neutral version of value. The idea here is that it strips out any other market movement, so you have a very pure exposure to stocks that are cheaper. It's also charted here with the 10-year Treasury yield. And you can see these two things track each other very, very closely. Again, for our radio listeners, both of these were heading higher at the start of this year. So there was some hope that we'd have value outperforming as the cyclical trade, as the reflationary trade picked up. But over the past few months, that had started to diminish. As yields started to drop again, so too did the value trade. However, with this recent spike higher in yields, again, for our radio listeners, we've seen a spike not just in the 10-year yield, but the value trade as well. I now want to bring in our queen of quants, our Justina Lee, Bloomberg Markets reporter, who joins us. So, Justina, I definitely stole this chart from you, so thanks first of all. But is it finally comeback time for the value quants?
I mean, that's like really a great question. And I think what we've noticed in recent years is you really need to pay attention to the macro environment. And what that chart shows is that bond yields are a very important factor here, because when bond yields are higher, people are looking for near-term cash flows. They're looking more for cyclical companies, which tend to fall into the value bucket. So if we do see, pretty decent U.S. economic recovery as well as higher yields, with the Fed thinking of tapering, I think that looks like a better environment for value for sure.
Okay, I love that. Quant Queen, give us all of the indications of what we can see actually on inflation. Are we going to see more repricing because of what's happened with, stagflation is now the buzzword. I think they're even talking about in coffee shops here in London.
Yeah, I think that's a great question, because what we've seen in the past week is really like a repricing of, expectations, for the Fed trajectory. But I think the question at this point is whether we need to be worried about, those higher energy costs, higher consumer prices derailing this recovery to the extent where, does it change the Fed's mind, or, does it really change kind of people's expectations of growth going forward?
Justina, obviously energy prices and the bond market are what we've all had our eye on, and that seems to be driving what happens in the equity market. Are equities just completely at the mercy of other asset classes right now?
It seemed to be that way in recent years. And I think one reason for that is we've been in that low rate environment for so long that it's really dominated a lot of the equity market internals. Because if you think about, what you should invest in when interest rates are low, very often, it's big tech, because, they have really strong structural stories that have very little to do with the business cycle. And you're looking at those long-term profits discounted at lower rates. And I think that's why we're seeing such a dramatic rotation in U.S. equities right now.
At what point, Justina, do people stop buying the dip? Stop buying? Because at the moment, it's like, oh, there's stagflation, inflation, we reprice everything. But let's buy the dip on equities.
Yeah, I think that's right. That's the lesson that I think a lot of retail investors have learned in recent years is you cannot do any wrong buying the dip. But I think that's why inflation is really important, because that usually is the trend that kind of derails both bonds as well as stocks, because it means that, asset value across the board is falling. And I think that's definitely a signal that a lot of people are looking at.
Justina, thank you so much. I love your new title, Quant Queen. Justina Lee there with the very latest on some of these market moves. Now, we'll have plenty more on the indices. We'll have plenty more, of course, on equities and treasuries. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua and Danny Berger in London. Now let's get the first word news. And British Prime Minister Boris Johnson says the country's fuel crisis is stabilizing. Johnson pushed back against industry demands to issue more visas to foreign truckers to fix the disruptions in the supply chain. Meanwhile, a retailers association says fewer gas stations have run out of fuel. U.S. regulators are leaning towards authorizing a half-dose booster shot of the Moderna coronavirus vaccine. Bloomberg has learned the FDA is satisfied that the booster is effective in shoring up production. The U.S. has already okayed the Pfizer-BioNTech shot as a booster. The U.S. bank with the most employees, Wells Fargo, has delayed its return to office date again to early next year. The lender will now begin bringing back employees who have been working remotely starting on January 10th. It's the fourth time Wells Fargo has pushed back its return to office date in recent weeks. And Amazon has launched a new robot called Astro, which works with its Alexa voice software. The autonomous gadget can check on pets while a user is away or follow a child through the home on a video call. Amazon is trying to position itself at the center of the booming market for smart home gadgets after a failed foray into smartphones. Astro will initially be sold on an invitation-only basis for $1,000. So it's not cheap, Francine, but it's pretty cute, and I kind of want one.
Me too. I'm not sure what it does still. I read the story 5 times. It does cost £1,000, but it's a little bit like the other guy in Wall-E. We're like obsessed. And I found out both Kailey and Danny actually have robots that clean around the house.
Yes, I love my robot vacuum, and honestly, I'm not going to spend $1,000 unless it's a vacuum as well. I'm sorry, it might be cute, but it needs to pick up its weight in the household. It's not getting rent for free, Kailey.
Very fair. My vacuum's name is Edgar, for the record. He's the closest thing I have to a pet.
I was going to say, I just have, small children and a husband. But actually, they don't do the job, so maybe I get a robot. Coming up next, Ed Clissold, Ned Davies Research Chief U.S. Strategist. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. Matt Miller off this week. Danny, the focus firmly on the markets. It seems that once again traders are buying the dip, but then so much actually concern about inflation or maybe even stagflation and what that means for central banks.
I still think the phrase of the day comes from Benjamin Browder of Bank of America, that it's a Pavlovian buy the dip response, that markets are now trained to do that. But there are fears that this won't last, and everyone from Benjamin Browder to RBC to Morgan Stanley warning that these are very fragile markets. And Francine, at some point that dip buying trade just isn't going to materialize and things could get worse from here.
Yeah, I don't know what the catalyst is, but certainly, Kailey, that's what the market is searching for.
Yeah, buy the dip may not work forever, but at least it seems to be working today in both the equity market and the bond market on both sides of the Atlantic. Of course, we're coming off really steep losses in both Europe and the U.S. yesterday, so the gains we're seeing this morning don't offset what happened in the Tuesday session. But nonetheless, they are still gains in Europe. The stock 600 up about 1% at this point. And of course, it was big tech that really lagged hard in the U.S. session yesterday because yields moved so sharply higher. Today, though, as yields come in, big tech actually looks like it may outperform with NASDAQ 100 futures up about 0.9%. Of course, as I said, yields coming in about 3 basis points on the U.S. 10-year. We're just shy of 151. And also retreating today is oil. WTI is down about 0.8%, trading at $74.68 a barrel, not able to maintain its highest level since October of 2018. Now, of course, with oil moving lower, you can bet energy stocks also moving lower in pre-market trading. That kind of is the story, though we are off session lows, and actually Occidental Petroleum has been able to flip into positive territory. It's up about 0.33% in early hours at this point, though you still see the likes of ExxonMobil and Schlumberger in negative territory. Danny.
Well, Kailey, on my end here, I have broken out the models, and specifically, I am looking at the term premium to help explain the recent rise in yields we've seen recently. I want to welcome our radio listeners as well. And for our radio listeners, what I have up here is a very simple line chart, and it tracks the premium that investors are demanding for 10-year versus short-term paper, just rolling that exposure over. Now, it had been dropping over the past few months, but just in the recent days, it's picked up above zero. Now, Michael Purvis over at Talbackin says that part of what's driven yields higher is not just thoughts that we'd get sooner hikes from central banks, but it is this. It is uncertainty that investors are confronted with. It's this inflationary story. Will it turn to stagflation? And at the same time, the debt ceiling. So because of that uncertainty, they're demanding more compensation for the risk of holding a 10-year yield. So again, Francine, this goes to part of the reason of why we've seen that big move higher across the curve.
Yeah, Danny, let's get straight. It's a great chart, so let's get more on this with Ed Clissold. He's Chief U.S. Strategist at Ned Davies Research. Ed, what happens to equity markets right now? We're going to see a sell-off continuing a little bit deeper for some of these high valuation stocks like tech, or actually are things going to normalize?
I wouldn't be surprised if we get a little bit more selling over the near term for several reasons. One, it's a seasonally weak time of the year, but probably more importantly, it looks like the momentum in the bond market is probably going to keep going. We'll get a steeper yield curve, as you just mentioned, and we're getting close to the point where historically it has become a bigger problem for stocks. If you look at the spread between the 10-year and the 2-year, if that gets above 1.5% or 150 basis points, that's when the S&P 500 usually runs into bigger trouble, and we're approaching that point. It's not like everything's fine at 149 and everything's terrible at 151. So as we get closer and closer to that, we're going to see more and more of these pullbacks until the market can digest the reality of the situation.
And the reality, Ed, is what? Are we going to see a big rotation actually into value stocks?
Yeah, we're approaching that as well. This is probably a reopening 2.0, similar to what we saw late last year into early this year. So it's probably more than just interest rates. The reality that, thankfully, the Delta variant appears to be fading, and the economy is going to reopen more fully. Now, we expect this to be a shorter and not quite as strong of a reopening trade that would favor cyclical stocks and small cap stocks, partly because the market doesn't do the same thing the same way twice, but also we're much further along in the economic cycle. GDP growth is going to be slower than what we were looking at, at the beginning of this year. The stock market cycle is more mature as well, and the Fed cycle is more mature. Earlier in the year, we were talking. Powell was talking about not even thinking about raising interest rates. Now we're debating about when the taper is going to actually start. So all these things are working against those cyclical stocks as well.
And Ed, monetary policy is only one part of the equation. There's the fiscal conversation as well, and a mess that continues on Capitol Hill. How do you think about fiscal policy when thinking about your investment thesis?
Well, the big picture is no matter what they do, it's not going to be as big as the 3 rounds of stimulus that went straight to consumers' pockets in the past year. So if you look at a year-over-year basis, fiscal policy is going to be getting relatively tighter. But it's always was going to be very tough. I mean, the Democrats are trying to thread a very, very thin needle hole with getting infrastructure through, the human infrastructure, and raising the debt ceiling. Everything has to go according to plan, and it's going to be pretty messy. In the end, they'll probably get something through, maybe not as much as what the progressives want, but they'll get something through. But you add on the tapering that's likely to start, monitoring fiscal policy and what the government is doing, is going to be quite a bit less than what we've seen recently.
Within all of this, the context, Ed, of course, is a 40-plus year bond bull market. What is the distinguishing factor between a momentary sell-off that's still taking place in a secular bond bull market versus a regime shift?
It's inflation expectations. If the horse gets out of the barn and we start getting wage push inflation, then it's a totally different ballgame. Then those comparisons to the 70s become more applicable. At this point, it probably is going to be transitory. I think if you want to look out to, say, the next 6, 9, 12 months, I think transitory is probably going to be a little bit longer than what people originally thought. We're looking at some supply chain problems that are popping up all over the place. But the wage push inflation doesn't seem to be, at least at this point, the main catalyst of the inflation concern. So it's probably too early to say that this is a secular shift in bond yields.
But for the equity market, talking about some of those supply chain concerns and higher input costs generally, how does that help you dictate what you do and do not want to own?
Well, you want to use companies with pricing power. So that's the number one thing. But we also want to watch profit margins here. Profit margins have rebounded so quickly. Usually it takes 2, 3, 4 years for margins to recover after a recession. They did it in a matter of months. So if margins come under pressure, which is not normal, this early in the cycle, then the earnings slow down, which is what we're going to see next year no matter what, because we're coming off such a low base this year and growth is going to be the best in 11 years. It's going to slow down. It could slow down even harder next year. And then it's going to be a lot more difficult to sustain the bull market if you get a real sharp earnings momentum decline.
Ed, as chief U.S. strategist, do you spend any time worrying about China and Evergrande?
We all have to, whether we want to or not, right? It doesn't look like it's systemic. In that it's not a Lehman 2.0 type of event, but it is symptomatic of the reality of the situation that China is not the growth engine that it had been. Demographics there are a challenge too. It's probably feeding into the problems with that one company. But if you're going to look for the driver of growth going forward, you want countries with strong demographics, strong consumers trends, and lots of innovation. Of course, you are talking to the U.S. strategist, but the U.S. really checks all those boxes.
Thank you so much, Ed Clissold there, Chief U.S. Strategist at Ned Davies Research. Now, coming up, easing the supply crunch. More on China's plans for power prices next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, New York Stock Exchange President Stacey Cunningham. That's at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
The supply side restrictions that are so much at the heart of the inflation we're seeing have not only not gotten better, they've actually, in some cases, gotten worse. Look at the car companies. Look at the ships dock, or with the anchors down outside of Los Angeles. And this is really a mismatch between demand and supply, and we need those supply blockages to alleviate, to abate, before inflation can come down.
Fed Chair Jay Powell discussing supply chain issues yesterday. Meanwhile, in China, the government is considering raising power prices for industrial customers and consumers to help ease the growing supply crunch that is threatening to slow growth and further strain those global supply chains. Let's get more on this with John Liu, our executive editor for Greater China. So, John, how bad does the power situation need to get for China to make a move like this?
So it's gotten pretty bad. We've had lots of economists cut their forecast for what growth will be in 2021. If China does raise the prices for industrial users, that might go a long way in solving this problem, because the issue is coal prices are way up because there's a shortage of supply, but power prices, what generators can charge for their electricity, is controlled by the state. And so you have higher input costs, but those generators are not able to charge more for that electricity, and so there's a disincentive for them to produce more.
So, John, what's the second or tertiary effect of this? How soon can they, put this in place? And what are companies saying?
It would help alleviate this disincentive. So you could see generators produce more energy. Higher prices might mean that companies are going to cut back on how much they use just because of cost. I think one of the secondhand effects will be there's going to be more coal burn. And so there will be more emissions, and in terms of climate change, this is obviously not what everybody's hoping to see.
Given, though, it's the world's second biggest economy, does this affect multinational companies who operate in China as well? What are the effects around the world of China's power crisis?
So I think the biggest effect will be on supply chains. So manufacturing in China, supplying end users in the U.S. and Europe, all of that's potentially going to slow down even more than how slow it is already, because factories are being asked to work 2 days of the week, 3 days of the week. And so there are going to be a lot of orders they're not going to be able to fulfill. We've also heard that companies have started not taking new orders because they know they are not going to be able to fulfill them.
John, we're also getting some headlines from the National Development and Reform Commission crossing the terminal right now. They say China will increase coal imports moderately. They will keep residential power and gas prices stable. And they say that power prices reflect changes in supply and demand. Of course, also in China, aside from the power crisis, what has contributed to a lot of the supply chain issues is really restrictive COVID-related mitigation measures, the kind of COVID zero policy. How big of a factor is that? And if we return to restrictions, if there is another surge, how much could that exacerbate these problems?
The COVID restrictions have been very strict, and that's affected a lot of industries, especially food, frozen food. It hasn't so much touched coal imports. The reason China wants to increase coal imports is because they are asking local producers to ramp up production, but it's really hard to do that in the short term. So the short-term solution is to buy more from overseas. The problem is they're going to be competing with buyers from Europe, from India for a limited supply, and so that's going to push prices up even further, and there's no guarantee they'll get those supplies.
John, we're also hearing, of course, on Evergrande and the fact that possibly we have government intervention at a wider scale. How much do they worry that some of these, price hikes in energy actually hurt them exactly at the same time where people are also discontent about Evergrande?
I mean, I think this compounds the headaches that the Chinese government has to deal with at the moment. The real concern, I think we saw this action today, is for the banking system. Evergrande owned a large stake in a small lender. They've now sold that to the local government. The proceeds from that sale, though, however, Evergrande is having to use that to pay back the money it owes that small lender that it used to own. So that money is not going to be able to help Evergrande pay off any of the other bonds and various other things it has liabilities on.
John, thank you so much. John Liu there, our executive editor for Greater China. Now, coming up a little bit later today, United Airlines Chief Executive Scott Kirby. It'll be a great way to look at whether the market is actually looking at the reopening of travel industry and, of course, whether people are starting to book their holidays. That coming up at 1 p.m. in New York, 6 p.m. in London. And this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua, Danny Berger in London, Kailey Leinz in New York. Now, in the latest episode of Peer-to-Peer Conversations, David Rubenstein sits down with the U.S. Supreme Court Associate Justice Stephen Breyer. Well, Breyer discusses how justices try to find common ground with each other on close cases.
What you read about are the ones that the press thinks the public will be interested in, which usually has a political or a social content. And they'll say, that's the most important. I don't know. One of the most important decisions I wrote this last year was called Google versus Oracle. Right. And it took a year for me to write that. It was about copyright and something called programs, interface programs. And I was told that that was very, very important. Well, for me, it was like learning Latvian. I mean, I don't know how I did that. But you see, I'm not saying I see what they're saying. I see what they're saying. And it's true that a lot of the sort of exciting cases are more close.
But do the justices, let's suppose you have a decision, it's 5-4, and one justice kind of go to another justice's chambers and say, your argument isn't so good, and maybe you should do something different, or is everything just done by memos and writing? You don't have people going down the hall and saying, let's have lunch together, and maybe I can persuade you my position is better than yours. Does that ever happen?
Most of it is memo, but quite a lot can be visits to chambers. But if I'm going into your chambers, I'm not going to say, no, your argument isn't so good. This would not be a helpful way to start the conversation. And if you go into somebody else's chambers, you better be prepared to listen to them, as well as hoping that they will listen to you. And then you try to see, and that's what I learned in the Senate, that's what you try to see is where is there some common ground? And is there common ground enough that you can work with it?
Well, United States Supreme Court Associate Justice there, Stephen Breyer, speaking with David Rubenstein. Now, you can catch the full interview tonight, 9 p.m. in New York. Now, we're joined by Tom Keene, co-anchor of Bloomberg Surveillance. Tom, you have a great chart. I love the fact you brought it back to 1976, looking at the 30-year yield. I mean, this was even before I was born.
Well, everything was before. You're so young, Francine. Everything was before you were born. This is the 30-year yield. It is what is most out of whack right now, and it really shows the artificiality of a time we live in. You take the 30-year yield, you take out the very high inflation right now, and the real yield plunges. And what is so important, Francine, is we have a massively negative 30-year yield versus the last time we had government budget upset, and also the last time we had crisis. It is a very odd time right now, making this September surreal.
Obviously, the budget and the debt ceiling front and center on Capitol Hill, but the real fireworks came from Senator Elizabeth Warren yesterday, Tom, telling Jerome Powell to his face she doesn't support him for a second term. What's your reaction to that?
My reaction is we've seen this before. There's nothing new here. It will be decided by the president. It's usually decided quietly. I believe the zeitgeist in the White House is they want Powell to stay, but there's a lot of people, as you know, pushing against that. There's a history of this, Kailey. That's all there is to it.
So that adds, I guess, to a surreal September. But I wonder, Tom, in the economists you speak to, do we have any more clarity of where the economy goes from here?
It's hugely opaque. And what's interesting is 10 years ago, 15 years ago, economists would boldly go out 12 months. And even there was a tradition they would publish out 6 quarters, I'll say. That's all gone. And right now, they're out a year guessing. And frankly, Danny, they're out to Q1 of 2022, and that's a mystery. People are tweaking along the way in that, but it's very opaque right now.
Tom, who do you have on the show?
We have John Farrow on the show and Lisa Abramowitz. We're making it up. We're making it up as we go. What we're going to be focusing on is the markets. The markets are the number one thing today. Elsa Lingos, you know her, Francine. We start extremely strong.
Great.
With Elsa Lingos,
Great
with her European heritage as well. And Dan Alpert will join us of the age of oversupply and the supply shocks of 2021.
Tom, I know you're definitely going to ask Elsa about her pound call. It's a pretty good one after everything we've seen in terms of energy shortages because of the lack of drivers in the UK. Tom Keene, co-anchor there of Bloomberg Surveillance, joining us. Now look at what else we're watching. And Kailey, you're watching at China and Evergrande.
Yeah, I am, Francine. I'm watching China in addition, not just the Evergrande, but the power story there. You're talking about power supply in the UK. It is very much an issue in China, and China saying it will vow to let power prices reflect demand and cost change. But the other part, of course, is the Evergrande crisis. They have another dollar bond payment due today, a $45.2 million coupon. We still don't really know if they paid the dollar coupon that was due last Thursday. Fitch downgrading the company again today, that credit rating, to just above default because they say it's likely they missed that payment. So we will see if they make the payment today. And the question for these bondholders, Danny, is still a giant question mark. We just don't know what's going to happen.
Exactly. We were talking to Tom McKenzie earlier, who was saying that they are just at the bottom of the list in terms of priorities, so certainly a continual concern for them. Well, Kailey, I am watching oil inventory, specifically EIA data, which comes out later today. What we want to see is whether or not it confirms data we had from earlier in the week that we saw the first increase of crude stockpiles in the U.S., the first one in about 8 weeks. Stockpiles have been low as part of the reason we've seen oil prices higher, so the way that this data moves could have a big impact on oil prices, Fran.
Now, what I'm looking at is the energy crisis here in the UK. We heard from Boris Johnson. I mean, he didn't give us that much confidence because he says he's hearing supplies are getting a little bit better. If you're in charge of a government, usually it's not your hearing, is that you set policy. And so we're still seeing or waiting to see whether soldiers will, be some of the drivers so that it's not an energy crisis as we don't have the fuel. We have the fuel, it's just not getting to the petrol stations. The other thing I'm watching is, of course, the James Bond premiere. It was last night, so I feel like half of London is hungover today. And it opens tomorrow. It does have an asset price impact. Cineworld actually shares gaining some 13%.
And everyone's going to be buying a new pink jacket to wear? Pink velvet jacket to go see the movie.
Maybe a little bit niche. But something that we'll watch out for very closely. I could see Tom Keene actually in pink velvet.
Oh, yeah, that look 100%.
Good. More Bloomberg Surveillance. Bow tie, there you go. We'll also hear from Elsa Lingos of RBC and David Rubenstein. They'll talk yields, we'll talk sterling. This is Bloomberg.